Good morning from our world headquarters in New York. I'm Menace Craney.
And from our studios in London, I'm Danny Berger. Welcome to the Bloomberg Brief. Let's set your agenda.
U.S. yields spike, the dollar rallies and stocks slip as the Fed signals it's likely to keep interest rates higher for longer. Next up, the Bank of England. The pound weakens for a second day as the BOE decides whether to hike for the 15th consecutive time. And central bank decisions aside, the risks loom for the markets. A long UAW strike, a potential government shutdown, all to play for into your risk this morning. A very good day to you, Danny. It looks like we have again got to reflect on what is the scale of this hawkish pause from the Fed. Two-year yields made it to the highest level since 2006 yesterday. And of course, it is that mixed messages from the Fed. They don't anticipate a soft landing as being the base case, but what you have here is two-year yields trading just shy of 2006 highs. We've done the Bloomberg survey this morning. Still nearly 60% say two-year yields have yet to peak. With that in mind, you look at what's happening with the oil market. You've got a monster trade going through for the third day in a row in $100 oil calls. 200,000 contracts have traded in oil. We're a little bit softer this morning, again, on this higher for longer narrative from the Fed, and another rate hike penciled, or in theory this year, puts a little bit of damage into the oil market this morning. This was the hottest trade of 2023. Inventories at Cushing are the lowest since 2022. But you're seeing monster $100 call trades go through. That takes us squarely to the pound. Now, the pound is at a 5-month low, 123.05. Last week was an 80% assurity that we're going to get a rate hike today. That's down to a towing cost. And it is all about the sell. Nomura say remain short at around 122. You could break to 118. But I want to take your attention to the bottom of the screen, which is Swiss government bond yields. We had a surprise hold from the SNB. This was the shocker. They remain at 1.75%. There was only 4 analysts out there in the market that presumed that down go the yields at the very short end in Switzerland. The Swiss franc, we'll talk more about that in a moment. So again, another little bit of a shocker from the Swiss.
Yeah, and is it a preview for the BOE of a potential pause there? I really love what Peter Scheer said, that we're looking at a Fed, at least, that is trying to find in the data an excuse to pause. Is that a global inclination? But look, we had the hawkish pause from the Fed, and the risk aversion continued well into the Asia session, certainly not buying anything in China. CSI 300 hitting its lowest for the year. Manis, you've been bringing this up all week. Perhaps we are not yet at peak pessimism. Perhaps the ceiling is even higher if you now, yet again, have to worry about a pickup in rates. European stocks also fall with the rest of the market. Only one sector in the green. Finally, S&P 500 futures, those are down about 1/4%. We're just at around 4,400. Julian Emanuel over at Evercore put it, confusion reigns supreme, Manis. It is the confusion over the Fed statement, risk asset stocks hate confusion. And Manis, in a very clear sign of that, here's my fun fact of the day. Jay Powell yesterday said, proceed carefully. That phrase 6 times in the presser yesterday.
Yeah, look, I think there are seeds of confusion. I know that we both hunkered in on what Standard Chartered have got to say. But what I would say to you is this. You have this shift in the dots that we talked a lot before we went into the meeting. And by taking those 2 rate cuts off the table for next year and the year after, still the market goes head-to-head with the Fed. The market is still pricing 80 basis points of cuts next year. The Fed is saying 50. That classical kind of marriage, which is breaking up, continues to hit the rocks. The market versus the Fed.
Well, I think it's also a case of the market. How much do you want to read into the dots? If they've downgraded unemployment to 4.1%, apparently we can still get there with unemployment at that figure. They're also looking at core PCE forecasts, which are higher than some expected. It is the confusion of the forecasts and the dots. And on this point, Steve Englander, this is what you were mentioning, Manis, from Standard Chartered, sent out a note overnight saying that we see the Fed as somewhat mystified by the resilience of the economy. Powell repeated that they are guided by incoming data rather than estimates of equilibrium, real interest rates, or any model. Manis, we are in the land of no models right now.
I think we're in the land of deep confusion. They just want pure optionality, don't they, Danny? Hence the reason why they've shifted on the dots for 24 and 25. Danny?
Yeah. Optionality, a good thing in this unknown environment. Well, don't take it from us. Listen to the man himself. Here is Fed Chair Jerome Powell signaling that higher for longer rate environment.
We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective.
Let's get over to Bloomberg's Valerie Teitel. Valerie, the other shocker in this decision was an upgrade to forecast of growth for this year, 2.1%. Do we need, though, to see a growth slowdown for the Fed to have confidence that the inflation is returning to target?
Danny, that is the big question that markets are grappling with. What exactly do we need to see in order for the Fed to drop this hiking bias, in order for the Fed to drop this threat of an additional hike next year? Is it below trend growth? Because it was only months ago he was adamant that we needed to see below trend growth to get inflation back to target. But he has softened that language recently. Even if we look at the revisions, the steep revisions to the Fed's own growth forecast didn't tempt any other members to push for a hike later this year. We still had 12 out of 19 members vote for a hike for the remainder of the year. That was reflected in that dot plot. The market is giving as well, raising an eyebrow to this forecast. We only price in a 50% chance that the Fed does hike again this year. If the stronger economy doesn't lead them to push the terminal rate higher, what does it lead them to do? Danny, you mentioned it all this morning. It leads them to leave those rates higher for longer, as that dot plot reflected, with those 2024 dots rising by 50 basis points. That's what really caused those two-year yields to break through cycle highs, weaken the equity market, and strengthen the dollar. Now, to be saying this, the Fed does seem somewhat mystified by the strength of the U.S. economy. Powell mentioned perhaps it's because the neutral rate is higher. Perhaps it means they haven't reached sufficiently restrictive yet, or it means they haven't held these rates high enough for longer. Powell said, "We don't know yet. We will be guided by the data," but he's thankful that they were out the gates hiking very far, very fast last year. It's given them a bit more room to breathe and that optionality to proceed carefully as the data comes in.
Well, certainly those words, the magic words, which are proceed carefully, from Powell, set the tone. Valerie, thank you very much. Valerie Teitel in London HQ. Let's get to Oliver Kettlewell, Executive Director for Fixed Income Fund Management at First Abu Dhabi Bank, our guest this morning. Oliver, look, risk has taken a bit of a slap. Those twos have popped to the highest level since 2006. We have this knee-jerk reaction, but yet the Fed, in his speech, in his press conference, Chair Powell did not put a soft landing as the base case. When you look at this hawkish hold, what does it take to deliver real rate hikes into next year? Good morning.
Well, I don't think there's going to be real rate hikes into next year. I mean, they're probably going to sneak one more in before year end. And then obviously now the higher for longer dot plot mantra, as you alluded to, I think the biggest casualties there are risk assets, whether it be high yield in the fixed income universe or stocks. I think, on the other hand, investment grade bonds, if they're going to yield now 5.5%, 6.5% for the next 2-3 years, I think that's great for bondholders because you're getting an equity-like return for a very safe asset class.
What needs to happen then if we continue to have higher for longer when we hit maturity walls, Oliver? What needs to happen to continue to prefer investment grade in that scenario when you have folks who took out financing in 2021 at much lower levels and they hit that wall in the coming years?
But that's my point in preferring investment grade over high yield, because I think it's going to hurt the high yield guys more than it does the investment grade. If you take the Bloomberg US Corporate High Yield Bond Index, the time to maturity is now below 5 years. That's the lowest it's been since that index started in the 1980s. That means that a lot of high yield corporates in the US and around the world, they're scared to roll over debt because they can't do it. They're having to roll over debt at double the rates they were doing it 2 years ago. Instead of 5% rolling over debt, they're rolling over debt close to 10%. So I think the big risk, to your point, is in the high yield space, whereas in the investment grade space, you've got a nice decent cushion now of yield. So even if yields do trend a bit higher from here, the downside is capped. If you take the 10-year, for example, if you buy the 10-year at 4.40 today, and yields go to 5%, then you're actually just going to break even over 12 months because of that high carry.
You say we're entering a golden age for the fixed income outlook. So you're not a bond man at heart, are you? But a golden age is your thesis. With that in mind, how much of concern have you got around supply? Because Chair Powell said he sees yields moving up, not because of inflation, ironically, but probably because of growth. And therein lies the real conundrum. It's growth and supply for him. How concerned are you about supply that pushes one more pop on the upside in the longer yield?
You mean supply of US Treasuries or supply of investment-grade bonds in general?
Supply of Treasuries.
Yeah, I mean, I think the surprise supply issuance over summer did take us a little bit by surprise, even though it was telegraphed. So yields, I think that's one of the reasons why yields reflated higher over summer. But at the same time, I think the long-term drivers of US Treasuries, and particularly over the next 12 months, are going to be the traditional forces of growth and inflation. And inflation is probably going to be the one that comes down, so hopefully there's no nasty surprises there. The surprise could be growth, and I think Powell alluded to that in his press conference last night, and the fact that they've penciled in 1.5% growth for next year, which is close to trend growth of 2%. Shows that perhaps the biggest risk for treasuries and bonds in general at this point is elevated growth levels.
OK, well, it's something that we can pick up in terms of the conundrum for the Bank of England in just a moment. Oliver Kettlewell stays with the brief. Coming up, the BOE, the rate decision, it's coming in less than 2 hours. We'll discuss that with Oliver Kettlewell and catch up with the economist Sarah Hewin at Standard Chartered, right here on Bloomberg. Good morning.
This is Bloomberg Brief. I'm Danny Berger in London alongside Manish Cranny in New York. So the Fed had its go yesterday, and then later today it's going to be the turn of the Bank of England. So will it hold or will it hike? This market on a nice edge following yesterday's softer than expected inflation print. Bloomberg's UK correspondent Lizzie Burden down the street from here at Threadneedle Street. Lizzie, set it up for us. What are we expecting?
Danny, you're absolutely right. This decision is on a knife edge after yesterday's softer than expected inflation data. Markets really paring back their bets on a quarter-point hike from the Bank of England. Many now seeing a hold. In fact, economists at Goldman Sachs and Nomura changed their call to see a hold today. The softer than expected inflation data was that at every level, headline, core, services. But not only that, we've also seen a weaker than expected UK economy. That data is volatile, though. The Bank of England's going to want to see that this is durable. And the thorn in its side is the hot wage growth that we've also seen in the UK. But at the same time, the dove of the Monetary Policy Committee, Swati Dhingra, has told us that's a lagging indicator. You have to wonder whether others on the committee are also looking at more forward-looking data like the PMIs. But we could get a sign of that in the guidance. Even if it's a hike, will it be the last hike? We will look for commentary on that. You've seen the pound sliding after the inflation data. It was $1.23 the last time I checked. Nomura says it could go as low as $1.18 if you get a hold or dovish commentary today. And the other thing to watch out for, Danny, is the gilt market. We are expecting an announcement on the pace of quantitative tightening. It's been £80 billion a year, likely to increase to $100 billion pounds, I should say, a year. But if it's even more than that, could rock the gilt market.
All right, Lizzie, thank you very much. Lizzie Burden there outside the Bank of England. Oliver Kettlewell of First Abu Dhabi Bank is still with us. Oliver, your call on sterling, 120. We're not too far from that. Would you want to downgrade that? Want to give us a new forecast in front of all of your closest friends who watch Bloomberg TV? Are you going to stick with 120 even if they hold today?
Well, we had that 120 call on when sterling was 130, so it was a lot harder to say 120 when it was 130. So, look, we'll stick to 120 now, and I'll leave it to the economists at Fab to update it later. But the reason why we think it's going lower, and I can even see Nomura's point to go to 118, is just because the rates differential is the only thing that sterling's got going for it at the minute. They might end up with the highest interest rate among developed market central banks, but apart from that, everything else is worse. They've got higher inflation and lower growth than the rest of the world, which we think ultimately pulls down sterling. So Manus can wait a bit longer before he transfers all his dollars and dirhams back to sterling, I think.
I think what we have here is probably Danny Berger looking for a much more expensive lunch. I've got the feeling that it's going to be like Gavroche. No, Gavroche is closing down.
He's got to pay up.
Yeah, you got to pay up and look large in this market, which then takes you to the conundrum, Oliver, which is if you look at the gilt market and you look at the yields that we have there, maybe we are at or near a plateau, as Hugh Pill said, versus where we are in treasuries, maybe incrementally a little bit higher. Where would you come down in terms of choice between gilts and treasuries?
Oh, I think definitely treasuries. One of the reasons is because just the bias is it's easier for us as dollar investors or predominantly dollar investors to buy dollar bonds, whether it's US treasuries or emerging market bonds or dollar bonds over there in Europe. But also I think that that the Fed is still more likely to cut earlier than the BOE, even though it's been sort of priced out towards the end of next year. I think that the problem with Bailey, I think he wants to be like Lagarde and Powell and kind of say that they're near the end. But as I said, the inflation problem is the most acute. So I think he really has to talk tough and say that they're potentially going to keep hiking, even if they do one more today.
Where do we stand on the fragility of this gilt market, Oliver? Is this a bond market in the UK with traders who are still willing to test and maybe even punish Andrew Bailey for continued missteps and misspeaks?
Oh, I think they will. I think you're right. I think that's why he's got a very difficult press conference today. But that's why I think, and ultimately they'll do the right thing and they'll hike by 25 basis points, and he'll try and sort of give the optionality language to the fact that they'll keep going just to please the markets, because he really has to, because the problem in the UK is so much more severe than the rest of the world. But look, on the other hand, gilts are not defaulting anytime soon, so I don't think that's an issue. It's just a question of price volatility.
Yeah, there was a little moment when we had Trustonomics where perhaps that was a different conversation.
Yeah.
Dollar yen. Yen's real effective exchange rate falls to the lowest in 53 years. Yes, I was around 53 years ago, but I didn't know what dollar yen was. How much of a spoiler, how much of this weakness in the yen could perhaps shift the narrative at the Bank of Japan tomorrow? To close, Oliver.
Yeah, exactly. I think it will. And if you want a more bullish call from me, I think the Japanese yen gets stronger from here. I mean, it's its weakest level now for, I think, since the early 90s or so. And, you couple that with the fact that Japan actually has above target inflation now. So that will force Ueda's hand. He will, end yield curve control and raise rates above negative levels probably at some point before the end of the year. Probably won't do it tomorrow, but I think he's going to do it sooner rather than later.
Yeah, that hand is potentially going to be forced. Oliver, thank you very much. Oliver Kettlewell at First Abu Dhabi Bank. Our guest this morning on the rates market. Coming up, we're going to bring you an exclusive interview with Spurs chairman Dan Levy. He says he's open to selling his stake in the club. More on the story. Who could the bidders be? On Bloomberg.
Would you be open to selling a stake?
My answer to that question has always been the same for 23 years. We have 30,000 shareholders who own approximately 13.5%. We run this club as if it's a public company. If anyone wants to make a serious proposition to the board of Tottenham, we will consider it along with our advisors. And if we felt it was in the interest of the club, we would be open to anything.
Has anyone made an offer?
Over the years, many people have made offers, but there's never been an offer that's been...
Well, give us an idea of what those offers have looked like. Where have they come from?
All parts of the world. The Far East, the Middle East, America. But nothing has been put on our table that we felt has been in the interest of shareholders.
Does that mean it was just insufficient in terms of size? Or it was the wrong kind of people and the wrong kind of contract?
Lots of reasons. For us... as a board, we look at we're only custodians of this club. We want to take this club to another level. I think we've shown progression over the last 20 years. We've made a big investment in our capital projects, in our team. And if someone came along and we felt that it could take us to another level, we'd look at it.
It was Tottenham Hotspur chairman Daniel Levy with a bit of a grilling from our very own Bloomberg's Jonathan Farrow, which was show me the money. What size of money was going to come on the table? You know what is ironic? I think there's a big culture issue with who could buy Tottenham Hotspur. You know, could it be somebody like Nick Candy, Ken Griffin, who came in and tried to bid for Chelsea? Or would it be Saudi money? Would that fit? Would Saudi money that bought Newcastle and United really fit?
Well, it definitely feels like the Americans and Middle Eastern money is coming for English football. Man, it's the most important thing to me, though, is Levy saying that with the money, they could buy back England captain Harry Kane. I was a Tottenham fan only because they had Harry Kane, because I could shout at the TV in my awful British accent, "You're a wizard, Harry." I'm not going to do the accent because it will get me canceled.
You're a traitor to your own postcode. You are a traitor to West London.
I know.
Yeah, that's a disgrace. But then again, of course, probably you're in favour of Harry Kane. Look, I'll leave you with this thought. I mean, some of the biggest deals have been done by the Saudis, haven't they? But take your mind back to 2008. It was in Abu Dhabi. It was Sheikh Mansour who bid up for Manchester City. And then, of course, you've got Jim Ratcliffe and Al Thani going head-to-head for Manchester United. So there's still a whole host of people that could play into this gig. Danny.
Yeah, all I say is don't discount the Americans. That Miami PE fund just bought Everton. It could happen, Manus.
American money, Middle East money, Asian money. We'll pivot to British money with Sarah Hewin, the head of research at Standard Chartered, as the BOE looms. Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. U.S. yields spike, the dollar rallies, and stocks slip as the Fed signals it's likely to keep interest rates higher for longer. Next up, it's the Bank of England. The pound weakens for a second day as the BOE decides to hike on a 15 consecutive time today or not. And central bank decisions aside, other risks loom for the markets. It's a long UAW strike and a potential U.S. government shutdown. Now, all of that combining together, but let's be honest, it's really the Fed, the dots moving higher in what has been a very risk-adverse session, man, as it continued well into Asia. Chinese stocks, they're at their lowest since November of last year. CSI 300 closing down by 0.9%. Stocks Europe, not much better. Last I looked, only one sector was in the green. Everywhere we are selling. It's very rare these days that we get a Fed decision and you keep having the risk off. Usually stocks, because they always go up, apparently, find a way to claw back. But Julian Emanuel says that stocks hate confusion, and confusion reigns supreme after that decision. So, Manus, you get a picture like this. S&P 500 futures just above 4,400.
Well, there was no confusion in the velocity in the short end of the curve, Danny, because we popped and rocked on the upside. This is the short end. Twos were popping up to the highest level since 2006. It would be good if I could find the right direction in a new studio. I just need a whole sort of set of markers for me. It's reorientation. The highest since 2006, and we've done the Bloomberg survey. Still, they think that the short end of the curve has higher to rock higher. Yes, the Fed has left 25 basis points on the table for this year. They did that hawkish pause. They pulled back to 50 basis points of cuts next year. The market still sees 80 basis points of cuts. There is a disconnect between the two. Oil, over 200,000 contracts per day for the past 3 days have traded through on Brent. Yes, we've come down. Higher rates gives you a little bit of pressure on the oil contract because stocks rocked. We went to this knee-jerk, complete risk-off narrative. But over 200,000 contracts per day have traded through on the Brent contract for the calls on the upside. That leaves you to the pound. We're going into the Bank of England today. And again, Nomura calling a softer pound. You want to be short at 122, down to 118. You've got CBW talking about 120.75. We've just had Oliver Kettlewell again talking about the momentum on this currency. Is it sterling weakness? I would say it's sterling weakness as well as a rejuvenated dollar. And keep an eye on Swiss rates at the bottom of your screen. You're looking at 2-year yields where the SNB left rates on hold. That was a surprise. So they're sticking at 175. They're not going to be pushed around by anybody else. So quite a bit of momentum there. But look at dollar yen, Danny. Red headline on a strength basis, on a weakness basis, excuse me. It's a 53-year low.
Yeah, that BIS reported the real effective exchange rate. Manis, after the BOJ last time tweaked their yield curve control, there was this conversation of what happens when they get a test from the Americans, when something happens from the Fed or from the data where yields march higher. We're getting that test now. JGB 10-year yields, those are also at a 2013 high. And of course, we were just talking with Oliver Kettlewell. Maybe the BOJ is where the surprise comes from this week.
Well, we should caveat, yes, he says that that's potential with a surprise. He doesn't think they're going to blow off yield curve control now, but that is going to come incrementally forward in the calendar relative to what everybody else thinks. For now, though, Danny, the momentum is still at the short end in the rates in the US because they have not done. According to the Bloomberg survey, and 10s still have not topped out. They will top out somewhere around 4.5%. Danny.
Well, let's get back to that Fed decision, because there was a little bit of confusion around the soft landing. Jerome Powell, the Fed chair, did say that a soft landing for the U.S. economy is the primary objective for the central bank.
Is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that.
Sarah Hewin was watching, listening, as was Danny, as was I. She is the head of Europe and America's research over at Standard Chartered. Sarah, good to see you this morning. Tell me this. Do you now have any better clarity on what higher for longer is by them taking rate cuts off the table in 24 and in 25, skimming those back? Does that help you understand that they're digging in for higher for longer?
That was a very clear message, not just from what Powell was saying, but obviously from the new dot plot. And also the backdrop, I think, one of a strong-ish economy, an economy that slows to slightly below trend next year, but then recovers back to trend, having performed very well this year. And interestingly, unemployment, which barely budges. So the Fed seems to be saying we are in this Goldilocks scenario where we have a strong economy, low unemployment, and they clearly feel comfortable to an extent that inflation is going to be moving towards target over quite a number of years, I have to add. They don't have inflation down at 2% until 2026. I think that there was quite a large degree of caution in those forecasts because unemployment barely budging does raise the risk that wage earnings growth just doesn't fall in the way that it needs to if inflation is to move to target. So I think that is really behind. That's the backdrop
and Sarah,
to the rates high for longer.
The backdrop is also a Fed, an FOMC, a Jerome Powell that doesn't have control over oil, doesn't have control over labor strikes and wage negotiations, and doesn't have control over Treasury supply. Does that worry you?
Yeah, I mean, Powell addressed each of these, and in terms of labour strikes, he said it depends how long they go on in terms of the impact on the economy, but also what message does it send for wage earnings growth and how sticky wages may be going forward. On oil prices, interestingly, we got back to the transitory commentary again. So oil prices, he says, are volatile and they only become a problem if it's high for a long period of time. Now, we think that oil prices are moving up, that we think that they're on an upward trajectory, and we don't expect that they are going to drop back again. So that becomes both a headwind for growth, but also potentially a driver for inflation expectations, which could be challenging for the Fed.
And on those inflation expectations, Sarah, I mean, I did the market check. I talked about oil, 200,000 contracts per day have traded through the oil market, again trying to set up for $100 oil. Now, gasoline prices have risen in this country. Rents, I can tell everybody officially, the rents have not peaked in this country, in this city. But, you know, you have those two big drivers in this economy, which is rent, owners' rent, and you also have oil prices and gasoline prices as well rising. Do you think that the inflation situation is anchored or at risk? I mean, I know the trend is lower. We've turned over, we've turned down. But talk to me about your view on whether we're in a more anchored inflation narrative here and continuing to decline, or do you think we're going to hit a wall?
I think we are anchored, and our view on the economy is a little bit more downbeat than the Fed's, and that's based particularly given the new Fed forecasts when, if they do indeed hold rates steady, then essentially we're looking at another 100, 125 basis points of tightening in real rates over the course of the next year. And we're already seeing some signs of distress. The economy has been doing well, but there are special factors behind this current quarter's strength. Credit growth is slowing, delinquencies are low, but they're rising. The job story is declining, and we think that the headwinds to the economy are rising. So that would suggest that inflation trends should move lower. I'm not so concerned about the energy costs or indeed the sort of shelter rent costs, because I think ultimately new rentals suggest that rents will come down. So it does get back to this core services question, and there wage growth is key. If wages do continue to nudge down, and they should do if the labour market softens, then inflation will also fall.
Manus, you know what's really fascinating? Sarah, they're talking about wages falling in the U.S. Here in the U.K., we still have very stubborn wage inflation. But does that CPI figure from yesterday shake something up? Manus, you and I covered it extensively. It moved the entire bond market.
Yeah, but this is where, Sarah, and Seema Shah said yesterday to us, warned us yesterday, that we shouldn't be fooled. We had this knee-jerk reaction on the back of the CPI. That's the point that Seema made yesterday, Danny, isn't it?
Yeah, no, it's exactly that it's one piece of data. It doesn't make a trend. Sarah, for you, how much do you want to read into that cooler than expected CPI? Does it allow Andrew Bailey to put rates on hold?
They'll certainly be considering a hold decision today, but we think that it's a knife-edge choice. We think that on balance they will raise rates again, but very prepared to be proven wrong in a couple of hours' time. The wage behaviour, the labour market does seem to be softening. Wages have been really sticky. They're very high, and of course we're coming down on inflation, but from a very elevated position. We're way higher than inflation in the US and in the euro area. So arguably there is still more that needs to be done. And we're not particularly getting clear signs that the economy is about to hit the wall.
Okay.
So that overall, I think another rate hike is possible.
Well, there's another brick in the wall. Excuse the pun. We try and look for the number ones and number twos here. But cable is traded at 123. It's just broken 123. Oftentimes people go, central banks don't look at currencies. Well, the Bank of Japan does, and the ECB, even if they don't admit it, they do. Here we are. Sterling is under pressure. That's a construct of dollar strength. But what are the ramifications of this weaker sterling? We've got Nomura calling it down to 118 on cable, and other calls for lower sterling. Just talk us through what that means from a macroeconomics perspective for you.
It's bad for inflation, and it will be a concern to the Bank of England. I'm not sure that whichever decision they take today is going to help. If they stay on hold, then that will be seen as dovish. If they hike, then markets may feel that they've just gone a step too far and that ultimately they'll have to cut rates more. So cable is under pressure, particularly given the hawkish hold from the Fed yesterday. And the markets do worry about the fundamental risks to the UK economy, even though we're still growing. I think the concern is that a recession risks are probably highest in the UK of all the major economies.
All right, Sarah, well, we got an hour 20 minutes ago until the BOE decision. We'll let you go get some lunch beforehand. We all got to refuel for what is a very close call. Sarah, thanks so much. Sarah Hewin of Standard Charter. Now, coming up, the UAW's chief negotiator says Stellantis' new offer doesn't look good, suggesting the union will keep digging in its heels. We got that for you next. This is Bloomberg. This is Bloomberg Brief. You're looking live at the Principal Room. Coming up later today, an interview with Nir Barkat, Israeli economy minister. That's at 11:30 a.m. in New York, 4:30 p.m. in London. This is Bloomberg.
For us, the Palestinian issue is very important. We need to solve that part, and we have good negotiations continue till now. We gotta see where it will go. We hope that it will reach a place that it will ease the life for the Palestinians and get Israel back, as a player in Middle East. Every day we get closer. It seems it's for the first time a real one, serious. We gotta see how it goes.
That was the Crown Prince of Saudi Arabia, Mohammed bin Salman, telling Fox News yesterday that the kingdom is getting closer to normalizing diplomatic relations with Israel. What are the roadblocks therein? Most likely over Palestine. Anwar Gargash here from the UAE yesterday talking about the very same topic. Let's talk about some of the other stories we're tracking from around the world, setting the agenda for you today. Ukraine's president met yesterday with Wall Street leaders, including Ken Griffin, Bill Ackman, to discuss using private sector funds to help rebuild the country. Now, the meeting comes as Russia hits Ukraine with its heaviest barrage this month.
Now, Manis, over in D.C., we're all on shutdown watch yet again, and House Speaker Kevin McCarthy won the support of a few of his party's hardliners last night. It's an effort he has right now to pass a short-term spending bill, but the risk of a U.S. government shutdown remains high, Manis. It's just 10 days before a funding collapse.
Meanwhile, the UAW enters its 7th day, Danny, of strikes. No signs of resolution with the big three automakers. Now, the strikes, they will expand tomorrow. They're set to expand tomorrow. Negotiators don't prove fruitful. He's tracking every twist and turn in this story. Oliver Crook is with us. So my reading is there's another new offer on the table, but one of the big three automakers are not biting. Oliver, good morning.
Good morning, Menace. That's right. We're about a week into this now, and we've got the 5th offer from Stellantis on the table to the negotiators. Still some distance apart. We heard from the negotiators saying it did not look good for us. But what's interesting is what he went on to say is the holdup is product. They didn't want to line up products for our plants in the future. So as much as this is a strike about wages, a living wage for an auto worker in the United States in 2023, this is also about the intense anxiety about the future of this profession and this industry. The EVs, for example, which require a lot less assembly and a lot less parts. And for the auto companies themselves, they may not want to commit not knowing what the future of this industry looks like.
I mean, it's not too dissimilar. I mean, obviously wildly different, but what's happening in Hollywood, the fears of AI and what that does to writing jobs. So, Oliver, if the car makers themselves, the big three, the Ford, the Stellantis, the GM, if they don't want to commit not knowing the future, how do they respond concretely to this?
Well, so far, you know, Ford and GM also have had no luck as far as it goes with these agreements. Mary Barra yesterday going out reiterating, saying that the costs and the demands are just way too high. We understand that GM's latest offer is worth about $150,000 annually, all in terms of what the compensation is worth. That's not what they'll make. That includes benefits. But what's interesting is now the spillover we're starting to see. GM has idled a plant in Kansas. We understand that affects 2,000 workers. Stellantis idled some workers as well. And there's also spillover in terms of labor. Another part of the UAW, which is not to do with the big three, but works in parts, they've also walked out in Tuscaloosa, Alabama. Who does that affect? They build axles for Mercedes-Benz.
Tuscaloosa, Alabama. Listen, before I ask you what's next, I'm going to ask it. Yeah, let's throw him a curveball. So who's going to go first when it comes to AI? Anchors or reporters? Who's going to bite the dust first, Ollie? Be very careful.
Listen, I don't want to talk my own book because that would be pretty poor reporting, but I have to say that perhaps the reporters who go out into the field and just sort of stand in the rain and all that sort of thing, I don't think you can convince an AI bot to do that.
No. Who taught you to stand in the corner? Who taught Ollie to stand in the corner, a street corner in the rain? Hey? Yeah?
Yeah,
That's
I think
right.
it was Manus. Didn't Manus teach you how to do that? An AI could never teach you how to do that. And that, therein lies the value of Manus. Me, I'm kind of worried. I need to think of why the bots can't replace me. I've now gotten suddenly very worried.
No, definitely not. Don't worry, Oliver. No bot is going to replace you. I just need you to get a social media account and help us all the way. Tracking the story live and in person, Oliver Crook.
Ollie, thank you so much for your help there. All right, that's the latest there with UAW and the future of our job security. Not looking great. Anyway, coming up, a look at some of the market moving events to watch throughout the day. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. All right, let's get you set up for your trading day. Here's what's ahead. We're going to Bank of England rate decision that comes at 7 a.m. Eastern time with a pause or a hike hanging in the balance. These markets, they are divided on that after the CPI yesterday. Then we're also going to be getting the latest read on U.S. initial jobless claims. That will hit at 8:30 a.m., followed by existing home sales. That one comes in at 10 a.m. Then we're also going to have President Biden welcoming President Zelensky to the White House at 3 p.m. Of course, he was in New York for the UNGA. Manus, we also, after the BOE today, we have the Bank of Japan tomorrow, feeling the pressure of higher yields in the U.S. and a stronger dollar.
Absolutely, and we know that they've got form, they've got history in sort of almost like silent assassin intervention, and then we go, whoop, what happened to dollar yen? It is the real effective exchange rate. We touched on it earlier. It's important. If you're waking up on your way to work in New York, it's dollar yen is actually where the big action is. This is a record low going all the way back. Our data goes back to 1970 at Bloomberg. This is the pressure for the new governor at the Bank of Japan, Danny.
Yeah, and, you know, Janet Yellen even this week gave the green light essentially for the MOF to intervene in their currency. Maybe that's the route they go because, as one hedge fund trader put it to me, Ueda doesn't want to be that guy, Manus. He doesn't want to be that guy that finally breaks growth in Japan.
Here's the other thing. Does unilateral intervention really fundamentally change the direction of a currency, or do you need G2 or do you need G3? Have a look at the crosses. You've got yen weakening overall. Yen, the dollar is down. You've got the euro. You've got a little bit of friskiness in euro yen and in sterling yen. Michael Metcalf says at State Street, yen is still way too cheap. It's becoming more of a hindrance than a help to the rationale to at least stop further yen weakness. That's the key for Michael over there.
Yeah, man, it's probably just worth whipping through what this bond market is doing after those big moves, those cycle highs for the front end that we saw yesterday. Not last year, certainly yesterday. Front end comes in just ever so slightly, 2 basis points, still at 515. But Manus, still pressure in the long end. Is it about growth? Is it about Treasury supply, as Powell himself said?
Well, you know, proceed with caution. That was the message from Fed Chair Powell. We've also done the Bloomberg survey. Everybody should jump on and look at that. Fed Go. What you've got is a lack of belief that the Fed is done. On the short end, yes, they've left 125 basis point hike on the table, but the survey says still higher to go on the short end of the curve and higher to go on the longer end as well. So there's a lack of belief. And the market believes, actually, ironically, there's going to be 80 basis points of a cut next year, not the 50 that the Fed have said. But it's not all macro, is it, Ms. Berger? We have a little bit of micro.
Yeah, we do. Why don't you kick it off with FedEx? What's going on over there, Manus?
Are you sending me a gift? Is that what you're doing? Are you sending me welcome to America? Yeah?
I know New York is expensive, but London's not that much better, Manus. I can't be spending willy-nilly, sending you gifts.
I expect everything. Look, there you go. We're up just under 5% in the pre-market. What is it? They have basically hiked their estimate for the earnings per share. So it's a nice bullish call for them at the front end. They've raised the lower end of the fiscal 2024 EPS forecast. Basically, it's bullish. And you've got Citi raising their call there to $300. Danny, there you go. Twists and turns. I just need a new roadmap for this big space. It's a big, big space. I'm lost.
I literally thought you were about to say Rolex, and I was going to say Manus.
Yes.
You got to wait for Christmas for gifts. At least Christmas, and then we'll get there.